One of the curiosities in markets is that despite trends appearing to move up and down seemingly at random, they do actually follow straight lines, which at first can seem invisible. In trading terms, we call these straight lines trend lines. Okay, no question, this is super basic, and at first glance, most aspiring traders would automatically think that they know everything that there is to know about such a simple subject. But quite often in markets, the simple tools get summarized and skipped over in the thirst for quick answers when people start learning to trade. It's worth taking a pause and considering just how much there is to say about the humble trend line. Let's start with the easy bit first, the bit that everyone thinks that they know how to do, but quite often it's surprising how many people actually get this wrong, and that is how to effectively draw trend lines. In the case of a market that is trending higher, we get a sequence of higher highs and higher lows. And what we're looking for is we're looking to draw the trend line on the underside of the actual trend in the case of a bullish market. So what we look for is these two swing low points here. Once we've got those in place, we can draw our trend line on, but only once we've qualified it. And the qualification is moving 50% back up this swing. Once you get to this distance here, you can then start to say, is this an uptrend in price? And then from there, you can draw your trend line on and then project that forward. What we're looking for from here is we're looking for the market to then retrace back down. We're looking for that third touch to be act as support on the trend line and then trade it higher from there. In the case of a downtrend in price, is an exact mirror image. What we're looking to do is draw the trend line on the upper side of the market. So it's on the top side there. And what we do is we look for two swing high points. And once we've got that, we can qualify it by looking at when the price then gets halfway distance of this move. We can then start to say this is a potential place where we can put our trend line and we draw it from top to that swing point there and then project it down to the right hand side. From there, what we look is we're looking for this to break down, and then the next touch of that trend line, that is what we're looking to act as a form of resistance and then trade that to the downside. But that is how we correctly draw them in both a bullish market and also a bearish market.
So remember, for a bullish uptrend in price, the probability is slightly higher that the swing lows will conform to a straight line, and that is why we draw from underneath. For a bearish downtrend, the probability is slightly higher that the swing highs will conform to a straight line, and that is why we always draw from above. Okay, let's take a look at a couple of examples. This first one, you can see the euro against the Canadian dollar. This is a 4-hour time frame, and this swing low here, this area I've highlighted, and that is our second low there that I've highlighted. And if we connect the two together in those areas, you'll see that we get a trend line and we start to map out how the market is moving higher. What we're looking for from here is we're looking for the market to come and reconnect there, which it does in this example here, and you can see that presents us with a opportunity to trade to the upside, and that's exactly what we get in this instance. This is an example of a downtrend. This is the Australian dollar against the Canadian dollar, and you can see that we've got our swing highs in place, number 1 here and number 2 here. If I connect those together with a trend line and we project to the downside, you can see that we do get very nice interactions with that trend line every time the market returns back to that area. This is possibly the key one to aim for there, and that presents us a decent shorting opportunity as a result of that. Here's a quick pro tip for you. We can get false breaks which start to question your decision, making it far harder to know if the trend line is actually right or not. They are very, very easy to deal with. All you really need to do is make an adjustment to the trend line over time. And that is perfectly normal. You can see in that instance. So I then compensate for the adjustments for the false breaks above, and then we get a decent trading opportunity as a result of that. So let's summarize that then. Trend lines help us forecast a trend in price. We connect two swing points together to draw the trend line. What we do then is we then use that line to anticipate a trading opportunity once the market connects with the line for a third time. What this does is it gives us a sense of proportion, a sense of market clarity and direction. They have memory. As more traders see them and they focus on them, that puts more emphasis on that area in the market. But always remember, they do not last forever, and at some point they will break. When that breakdown does occur, it usually signals to the trader that the trend has probably come to an end.
So that's a great starting point. Who'd have thought that it was possible to deduce so much detail from such a simple straight line? It's important to always remember that any technical tool is just that. It's just a tool. The trick is to know when to pull it out of the bag and use it, and when to put it on one side. Practice is key. The more you practice and experiment, the more you'll see how valuable and powerful the simple trend line can actually be. Don't forget to like, comment, and subscribe, and we'll see you in the next one.